The time now coming up on 8:45. All eyes will be on the Federal Reserve today as it makes its latest announcement on raising interest rates for what would be the fifth time. Ernie Burns from Burns Estate Planning and Wealth Advisors joins us now to weigh in on the importance of this. Good morning.
Good morning.
So 3/4 of a point, a percentage point is what we're looking at?
Yeah, the market has it baked in. They know today it's going to be raised by 3/4 of a point. But the real eyes are out now on the central bank in December. What's going to happen in December? Are they going to pause a little bit or maybe only raise it to half a point from 3/4 of a point, lower it down a quarter point? That's the whole goal. If they can lower it down to half a point, the market will actually have a bump on this.
You know, there was a consumer spending report last week that came out that showed that consumers were still spending money. The theory some economists had was there was still maybe some leftover money from stimulus and for whatever reason. So the point being that the Fed really is struggling a little bit to cool this economy, isn't it?
He has, but in the same instance, he was late on the picture. You know, we talked about that beginning of the year. In the same instance, he has a difficult job. His job is to get people laid off, to slow the economy down, to slow supply and demand. It's a difficult job to put people out of business. You know?
Well, and for Jerome Powell, the Fed chairman, who will hold a news conference, isn't that really kind of the dicey aspect of this? Is that the message? It's a real messaging challenge.
Yeah. He doesn't want to have, like we were talking about prior, a stagflation. He doesn't want basically prices to stay up and then items actually at the stores to actually shrink in size. And that's the real stagflation.
Sure.
You know, people have seen water bottles get smaller and smaller through the years and thinner through the years, and products and services not to be as equipped or as manufactured as well, because they basically are using cheaper products and services. So it's a very touchy subject. But right now, his goal is to basically get companies to stop hiring, maybe even to fire a few people, to slow the supply and demand down.
But as you point out, there is a risk, if they don't play it right, of stagflation, which was coined in the 1980s, the 1980 economy, which had 13.3% inflation, I think it was, and unemployment that was in the 10% range. You're supposed to be able to have one without the other. That's a bad place to be.
Yeah, it is. But here's the good thing. The CPI comes out in another week and a half, and the Consumer Price Index comes out, which measures inflation. This will be the third time in a row inflation should lower from 9.1 to 8.5 to 8.3. If we can get that thing under 8 and get into the 7s, so by the end of the year, to maybe 7% by the end of the year, you see the economy, you see the market start coming back.
You'll see the market coming back because people will make investors and people who run 401ks will be looking at profits and saying, okay, there's light at the end of the tunnel.
That, and the market's always trying to stay 3 to 6 months ahead. So the economy would be slowing, but the market would actually start having a bump.
All right, a little bit of optimism there.
Yes.
We'll look for that.
Yes.
Ernie Burns, thanks, Ernie.
Thank you.
All right.